You're listening to a CNA podcast.
Hey there, friends. It's Andrea, and this is the Money Talks podcast. So, the financial world was a pretty crazy place, wasn't it? The headlines were wild with scary words: stock rotation, market meltdown, massive sell-off, the great unwinding. The key US indices, the S&P 500, the Nasdaq, and the Dow, all slid uncontrollably, resulting in a $6.4 trillion stock wipeout, sending a wave of panic all over the world. Even Asia wasn't spared. An event like this, it's sometimes called a correction. It's also what traders and investors view as an opportunity to, quote unquote, buy the dip. When stock prices have dropped low enough, they actually become attractively priced. For those panicking right now, you should know that stocks have since recovered, but to relatively flat levels, at least for the S&P 500, which is a broad marker of the US markets. But does that mean that you should panic? When is a stock price low enough to make sense for you as an investor? And should you be panicking, like everyone else, watching the market's every move in order to make a decision? Sounds so anxiety-riddled, but you know what? I have someone who's going to calmly tell us what to do and what to avoid in a market crash. He's no stranger to Money Talks too, so let's get comfortable now with Eddy Loh, Chief Investment Officer at Maybank Group Wealth Management. Good to have you back, Eddy.
Well, thanks for having me again.
So, let's get things straight here, Eddy. Why on earth is a financial disaster like this one called a correction? It almost sounds like an oxymoron because the term correction is like a positive word, but it means something quite negative in the financial markets.
It depends whether you are really owning stocks or not when the sell-off happens, right? If you have stocks, a correction happens, you are not going to be too happy. But of course, if you are loaded up in cash, correction could potentially be a buying opportunity for you.
So it really depends on which side of the market you're on.
Yeah, but by definition, when we see a broad market index such as the S&P 500 correcting or declining more than 10% from its recent peak, we will define it as a correction.
Okay.
So S&P 500 is a good example when it sold off on Monday. But there is also another definition when we talk about bear markets. So that is when the market or the index actually corrects more than 20% or decline more than 20% from the peak. And we actually saw that when the Nikkei 225 actually sold off.
Right.
On the 5th of August.
Okay.
In fact, actually Nikkei 225 on that day itself, it was down by 12.4%, the biggest drop since 1987. But having said that, what matters is not just the magnitude of the decline, not whether it's 10% or 20%, but it's also the duration.
I see.
Because if you think about it, like, for example, if you recall global financial crisis, we actually witnessed a prolonged bear market.
Yes.
Starting from October 2007 till March 2009. Almost 1.5 years. But in comparison, the more recent COVID crisis, we also saw a bear market type of decline, more than 20%. But it was only for a very short period, Feb to March.
Oh, that's right.
And that's because the policymakers were responding very quickly with both fiscal as well as monetary policies. And the economy was not exactly in such a bad shape versus the time where global financial crisis, where there were lots of excesses. US was going through a housing crisis.
Yes, I
remember. So it took a long time to really deleverage and get out of the mess.
I mean, it's not in anyone's control how long something like this lasts, really.
It really depends on the fundamentals.
Okay, so who usually loses in a downturn like this? What does it mean when the Japanese stock market drops to a 37-year low? It sounds all very serious.
Obviously, if you are equity market investors, especially in Japanese stocks, I think you will be panicking quite a fair bit. On Monday itself, I think a lot of investors felt that way because we did actually receive quite a fair bit of query from our investors.
Right.
But on the flip side, we actually saw some safe haven trade as well because there were some recession fears linked to this recent sell-off. And we actually saw some safe haven type of assets, for example, the US Treasuries. actually they registered positive returns during this sell-off.
Right.
Again, it depends on what you're holding. If you're holding equities, not so good. But if you're holding some US treasuries, actually it's not so bad.
Yeah. So we've seen market crashes before, Eddie, or stock wipeouts, whatever you want to call it. So what makes this particular one that we just saw any different?
Well, if you look at the latest sell-off, I would say there were two main triggers for the sell-off. One, more fundamentally related, was actually growth or recession concerns. And it was really triggered by the very weak jobs data that came out from the US. And also, I think more significantly, unemployment was ticking higher to 4.3%.
Okay.
And because of this uptick in unemployment rate, there was this SAM rule recession indicator.
Yes, I heard about that. Tell me about that.
This SAM rule was actually, this economist called Claudia Sam invented this SAM rule. In simple terms, it measures the difference between the average of the last three unemployment rate.
Okay.
And they compare it with the 12-month low. When that difference becomes more than 50 basis point or 0.5%, then it actually triggers. It sort of like indicate that, a recession is, they call it as an indicator.
Right.
And because unemployment went up to 4.3%, so investors were a little bit spooked, like, is a recession really coming?
Right.
But having said that, the inventor, Claudia, she herself said that maybe this time round is really not that applicable. And one of the reasons is because if you look at the unemployment, it was really triggered by a sudden surge or inflow of labor supply, mainly from immigrants. Not so much about job losses.
Right.
So companies were actually not laying off people.
There were just more people in the market.
In a very short period of time. That's why unemployment actually went up for now.
So it pays to understand why figures go up and down in the first place.
Yes, indeed. And that's the reason why we think that, yes, I think there are signs that US growth perhaps is slowing, but it's not collapsing. So a soft landing scenario is still very much our base case. So that's on the fundamental side.
Okay.
But we do believe that another big trigger for the recent sell-off is more liquidity related. And that is linked to the unwinding of the Japanese yen carry trade.
Okay, so I'm hearing this a lot, the term carry trade, and it's involving specifically the Japanese yen in this context. Walk me through this. What's this all about?
So conceptually, carry trade means, like, for example, the Japanese yen carry trade means that investors actually borrow the Japanese yen at very low interest rate because the policy rate in Japan is still near 0%.
Yeah.
And once you get the yen, you can either deploy it directly into Japanese assets, like, for example, Japanese stocks, which were doing very well before the sell-off. Or you could actually convert it into a higher yielding currency, like, for example, the US dollar, which is giving you about 5% at this juncture.
Because that margin between the yen and the USD, that gap is so wide, you can make money out of it.
Yeah, you could make money out of it on the assumption that the Japanese yen remained weak. Some investors even took it one step further and took that US dollar, instead of putting it into cash, you put it into US stocks like the mega tech stocks. And that is driving, and that's one of the reasons that potentially could have contributed to the surge in some of these US mega caps.
So just too many people were doing these carry trades.
So it was becoming a very crowded trade. And then what happened was Bank of Japan hiked rates just incrementally.
Yeah.
But that actually contributed to a significant strengthening of the yen.
Wow.
So the yen against the dollar, I think, went from a high of nearly 162 to about 142 in a span of 1 month. This very sharp appreciation of yen led to what I define as a disorderly unwinding the Japanese yen carry trade.
Right.
It led to a sudden pressure on liquidity. So some investors were forced to unwind the trade. And if they had been holding, say, for example, US stocks or Japanese stocks, then they will also have to sell away these assets at the same time.
Okay, that sounds really messy.
But the saving grace right now,
there is a silver lining.
If you take a look at the unwinding, it's difficult really to put an exact number on it. But there are different ways to measure it. But one way we track is actually we look at the short positioning, the short yen positioning. We are now actually about 2/3 off the peak, which means based on that, perhaps 60 to 70% of the unwinding has been completed.
In that span of that
that 1 month or so, right?
Okay.
So what this means is that perhaps there could be further unwinding.
Okay.
But because a large part of it has been done, the subsequent unwinding could be a bit more orderly and less disruptive for markets.
Okay, here's hoping. Fingers crossed. So you've explained really clearly the two key elements that have contributed to the crash that we saw. Could we copy and paste what just happened to explain past and even future market crashes? I'm asking because I'm wondering, as an investor, can I spot the signs early to know, okay, it's time to, not to sell off, but to brace myself for what's about to happen?
I would say that conceptually, yes, because why do markets go higher? One, actually, the economy must be in relatively good shape.
Okay.
And two, the liquidity or financial conditions must be supportive. But when there are signs of excessive exuberance, where people become too bullish, and when valuations get a little bit too excessive, and everybody says that the bull market will go on forever, then perhaps it's time to maybe take a step back and say, hey, are we in a bubble or not?
Yeah, so that's the thing, right? How do we know if we're in a bubble?
I think one of the key things is actually when we take a look at the valuation and we see whether the corporate earnings growth outlook is supportive of the valuation.
I see. It has to be justified.
It has to be justified.
Okay. So there is such a thing then as too much liquidity in a market.
Yes, indeed. I think case in point, for example, global financial crisis 2007, I think that was a case of too much liquidity.
Okay, just a quick one here. Do you think we are almost there? Do you think we are in danger of 2007?
At this juncture, in terms of fundamentals, we feel that, yes, there are some signs of slowing, perhaps a little bit of an increase in growth risk, but by and large, we do expect the US economy and the global economy consequently to remain positive.
Okay.
Soft landing scenario. And plus the fact that because inflation is moderating, global central banks, including the Fed, are in a better position to ease monetary policy to support growth if necessary.
Okay.
So we feel that at this juncture, it is still appropriate to be exposed to risk assets, be it in equities or be it in bonds. Again, we have to be a little bit more circumspect here because if you take a step back, S&P 500 today is still at about 20 times forward price to earnings.
Okay.
A bit higher than your 18 times historical average. Granted, this valuation was actually pushed up by a lot of the mega tech. Because if you take the valuation of S&P 500 equal weighted, it is actually not as bad. It is just a tad below historical average valuation. So our suggestion to investors is really to, hey, take a broader exposure beyond the mega cap.
You can take a break from the Mag 7.
Yeah, take a look at some of the non-tech sectors, value cyclicals, industrial sectors, or even the energy sector, which perhaps presents a more attractive risk reward at this juncture.
Okay.
Not to say that we totally ignore the tech.
Of course.
But we do need to be more conscious of the valuation.
Diversify.
But even in terms of markets, we can look beyond the US.
Correct.
Global markets is not just about the US.
Yeah.
An area of sweet spot where we feel is right now is Asia ex-Japan stocks. Where the valuations are actually still a tad below historical average valuations and earnings growth trajectory is actually not too bad at all.
And you mean places like India?
Yes, indeed. A lot of times people feel that, Asia is just about China.
Yeah.
Right? And we all know that China, the recovery has been a bit more bumpy. But Asia ex-Japan as a whole, there are actually pockets of growth in other economies.
All right.
India, for example, South Korea, which is also quite exposed to the tech sector.
Yeah.
And even closer to home, ASEAN. We particularly like, for example, the Malaysia markets, which have actually done pretty well this year.
Yeah, even their currency is doing quite well now.
Indeed, and we are very optimistic actually about some of the investment plans that the government has pushed out. And already we have seen actually quite a fair bit of flows of investments into the country. You have Penang as the Silicon Valley of the East.
Yeah.
And then closer to home, we have the Johor, Singapore Special Economic Zone.
Yes.
I think that's going to bring about new business opportunities as well. And then out there in the eastern side, Sarawak, they are considered as a new economic powerhouse because of the focus on green hydrogen power, natural gas. So I think a lot of plans, there's a lot of potential growth opportunities in that area.
Okay.
Asia could be an interesting place to look at. And plus the fact, overall as a region, Asia markets actually do offer quite a fair bit of dividends. So with the expectations of lower rates, we think that dividend plays could also gain more traction.
All right. You know what? We actually did a dividend episode on Money Talks. Go check it out, by the way. So, wanted to touch a little bit more about buying the dip here, right? And you talked about maybe shifting attention away from the Mag 7, trying to diversify and perhaps think about stocks that are not normally within your periphery. Now, there's something to be said about when markets are bad, you can pick up stocks that were priced out of your budget previously, right? We're talking about, of course, your Apples, your Nvidias. Is that always true? Is there such a bad thing as a bad time to buy in this situation?
There are some saying that it's a bad time to buy the dip because one phrase, they call it catching a falling knife.
Yeah. Oh, ouch.
When the market is falling and then you try to catch it and then it's like a knife that keeps falling, that would not be a good situation, right?
Yeah.
But having said that, I think at this juncture, what we are suggesting to our investors is that, hey, yes, while near-term volatility may persist, it could also be a friend because it could translate to new potential opportunities. So you can actually take advantage of the volatility and look into some oversold situation where the fundamentals of the stocks are still, really in good shape. And obviously, because of the sell-off, the valuation has become more attractive. One way we actually try to gain exposure is through some structured solutions.
Okay.
Where it's a play on the volatility.
Right.
Simplistically, you could actually get a better risk reward because of the heightened volatility.
Right.
And it also offers you better margin of safety in this regard. So that's one way where we can actually make use of the volatility.
Our final question here, and it's a classic one, but I have to ask anyway because it is on everyone's minds. What about those who already have stocks and we see them plummet in value? My husband's one of them. He's, my stocks are not doing well. I said, don't do anything. So should we sell? Should we hold? Or should we just ride this out?
First point that we suggest to our investors is do not overreact and panic sell.
So stay calm.
Stay calm. You do want to take a look at your portfolio, especially if you are taking on leverage, because the last thing you want is to have excessive leverage and be forced to sell out of good positions because of the volatility. I think that's the first point. But this is also a good time to take a step back and take a look at your portfolios and see where are the true gems and where are the lemons.
Ooh.
So it could be a good time to really get rid of the lemons. As in not so good positions.
Yep.
And then perhaps redirect some of these proceeds into the gems that you have been always wanting to get in.
So reallocation.
Some form of rebalancing, reallocation.
Okay.
Really move up the quality. This is an opportunity for you to move up the quality of your portfolio, right? But I think the most important thing is really to maintain diversified, not just within equities, but across asset classes. Because a case in point is really, for example, as I mentioned, US Treasuries or high quality bonds. They could be your friend if the economy turns out to be a little bit worse than expected.
Yeah, indeed. And I think that's really, really sound advice. And it's something that we keep saying here, and a lot of our guests keep saying here on Money Talk. Stay calm, reassess calmly. There is time for you to figure out what to do. Eddy, thank you for being our voice of reason here on the Money Talks podcast. I think the last time you were here, we didn't have this special segment. It's a fun one. I have a hat here. And this hat has about 5 random questions to do with personal finance. So pick one. So, Eddy. Oh, I'm interested in this one. Your random question from a hat is, what was your biggest financial regret?
I think one of the biggest boo-boo that I've made,
Okay.
and I am pretty sure I'm not alone here, is where you follow the advice of friends
Oh, no.
and say, hey, take a look at this stock.
Oh, dear.
It's going up. It has gone up 100%, but you go up another 100% more.
Oh, no.
And this is actually a small mid-cap stock that tends to be a bit more risky. I was a bit younger then.
Of course.
A bit more risk-taking.
Okay.
Going for some excitement, trying to go for that double and triple bagger.
Wow.
And of course, that did not turn out too well. And I lost, I would recall, 90% of my initial investments.
That is so painful. 4 figures, 5 figures, 6 figures?
Well, 90%. Because younger days, so the amount is actually manageable.
Okay.
But still, I think it's a lesson to be learned in the sense that when you do your investments, please really do your homework.
Yeah.
And do not just follow your families and friends, because by the time the news reaches you, you're probably the last few to receive it.
You know what? You can count this as a gain in your life, because otherwise you won't be here talking to us about the right moves to make, right?
I hope so.
All right, Eddy, thanks once again for joining us. Really good to have you back.
Thanks for having me.
So listener, we hope this conversation was a useful one for you. And as always, if you have any thoughts or questions about this particular episode, let us know in a message. Money Talks is available on Apple Podcasts, Spotify, and YouTube Music. Don't forget to rate us if you are enjoying the podcast. Big thanks to the team, Crispina Robert, Tiffany Ang, Junaini Johari, Joanne Chan, and Saya Wind. I'm Andrea Heng. Thank you for listening to Money Talks.